Good morning, I'm Chris Beach, and welcome to Charting Markets on IG Live. And of course, it's non-farm payrolls day, the main event of the week. After a few days in which softer US employment data has really animated hopes that the Fed will pause its rate hiking efforts until the end of the year. Jolts on Tuesday, job openings on Tuesday, and the ADP report on Wednesday, which of course has no direct impact on NFPs, but is often looked at as at least an indicator of where payrolls might land. Both were weaker and indicated that perhaps job growth is slow in the US. Yesterday, you also had, of course, PCE price index, the Fed's preferred measure of inflation, which came in line with expectations, but crucially wasn't stronger than expected. So another sign, perhaps, inflation continues to slow in the US, particularly. And all that meant that stocks found room to rally and the dollar weakened to an extent on hopes that there wouldn't be any more Fed rate hikes this year. And overnight, we had that slightly stronger China Caixin manufacturing PMI reading, which moved back into expansion territory, which counteracted some of the negativity from China this week around data. Don't forget, of course, the Chinese government now embarking once again on big stimulus efforts. So that's really an interesting thing to watch that we might be seeing. Not yet, of course, but over the course of time, maybe some more improvement in data if those stimulus efforts do begin to bear fruit. Payrolls, of course, 1:30 live on IGTV, expecting job growth of about 170,000. That's down from last month. Unemployment rate is expected to remain unchanged at 3.5%. Starting with the indices, beginning with the 100, currently trading at 74.84. And just as you can see, nudging its way back above the 50-day moving average. The last 2 days, it did do its best to try and close above it, but couldn't succeed in that endeavor. So it was beginning to look like we could be having a lower high. And I think if we do have a big reversal today, if we go back below 7,400 today and surrender these early morning gains, that might add to the view that maybe a lower high, yet another lower high, this index has formed. And that comes off the back of these lower highs we've seen since February, one in April, and then all the way down into July. The rally in July faltered at 7,700. You had another measly attempt at a rally into the beginning of August, took it back down to 7,200. So certainly a close back below 74.20 today would be a negative development, and then sets us up for another test of this big support zone, really around the 72.50 level, right down to the 7,200 or so lows that we had from March that held in July and then also held again in August. So a big area of support to be watched there if the sellers do take control again. Further gains, though, take us back towards that early August high around 7,600, and then on crucially to trendline resistance, currently 7,640 or so. By the time we get there, it'll probably be more down towards 7,600 itself. So an interesting one to watch for the FTSE as it tries to recoup a lot of the ground lost since late February. Looking at the DAX as well, there's another index that, while it hasn't been heading much lower over the past few months, aside from that brief move to all-time highs in right at the end of July, beginning of August, it hasn't really been able to show definitive uptrend. This is still very much in consolidation mode, unfortunately, and this is a fact of markets. Of course, they don't go up or down, they go up and down. Sometimes they do both, and it's really the DAX just consolidating after the big gains from September and October last year. Whereas there's still a lot more optimism in things like the Nasdaq and the Nikkei. The DAX, however, still essentially where it was at the beginning of May. Nonetheless, the buyers have determinedly stepped in repeatedly to defend that 15,600 area. It's just that in the short term, they then can't really drive it much higher than 16,400. It isn't yet in a downtrend, and I think if you maybe get close back above 16,200, that could put the uptrend back in focus. It's more still in consolidation. So range trading it, buying the dips for short-term upside, but we're yet to see that meaningful breakout above the July highs, which is the main thing we're looking for at the moment for the index. European markets have really just started to lag behind their US peers again after a very good start to the year, and have given away the leadership for markets to the US and indeed Japan this year. So as long as we stay above the 200-day, as long as we stay above 15,500, it's hard to muster a particularly bearish case. It's just in the short term, we're not seeing much upside either for this index. And then looking at the Dow, enjoying a decent recovery, knocked back a bit yesterday, Perhaps unsurprisingly, just a bit of weakness ahead of non-farms. Don't forget, of course, for US markets, it is Labor Day on Monday, so US markets are closed. So even if maybe we get a big change in payrolls and they are worse than expected, it might be that there isn't much of a rally into the weekend simply because people know they've got a 3-day weekend looming, potentially. Nonetheless, after dropping back from 35,000 yesterday, we've managed to move back and hold above the 50-day moving average after breaking it above it early in the week. So it is showing signs of recovery, with a close above 35,000 really opening the way back to these highs from July. It looks, if you can see from March, there is very much an uptrend in play here. It's not the smoothest or most relentless, but with fits and starts, it has continued to make headway. So if we do then see further gains towards 36,000, that helps to create a higher high and gives further strength to a bullish thesis. Don't forget, US markets, they tend to be a bit mixed at best in September, even in strong pre-election years like this one. But then Q4, as ever, starts to come around, which is historically the strongest quarter for markets. So that could give us that seasonality boost, at least in the short term. With recession fears still relatively absent, of course, people hoping the Fed might not hike again, maybe that builds a case for why we still see further upside in US and other equities into the end. Looking to FX markets, quieter as you might expect today ahead of that payroll report, with the dollar strengthening yesterday and mostly quiet, mostly unchanged in early trading so far today. Euro dollar, perhaps the one to watch. The signs of a rebound were there yesterday, were there earlier in the week, Monday, Tuesday, Wednesday, back above 109, rallying back above the 200-day moving average. But Wednesday and Thursday saw us hit and then retreat from 100-day moving average. Buyers doing the best to try and hold this one above 108 for the time being. So that's interesting. That if that level holds, and if the 200-day continues to hold, maybe there's yet hope. And of course, while it's always hard to guess what the reaction to any payroll report would be, even if you knew the number in advance, I think you'd probably be hard put to say what the market would do. It's fair to make a case that if we get another weaker payroll report today, if, say, wages don't grow very strongly or the unemployment rate rises, that might weaken the dollar and put the euro back on the front foot, put it back above 109, and maybe see it start to recoup some more of these losses that we suffered during July and into early August. Similarly for the pound, it's still in an uptrend, a little bit more choppy of late, but nonetheless back above the 126.65 area. That was an interesting area of support during the course of August. So the recovery of that, the recovery of the 100-day moving average, putting the buyers back in charge. And in its simplest form, of course, we're looking to buy the dips in an uptrend rather than sell the rallies most of the time. The fact you've got a 50, 100 and 200-day moving average that's still broadly rising, or at least moving higher, and a price that's overall moved higher since the start of the year, that's an uptrend. So we're looking to buy dips. This one has taken it back to its lowest level since the beginning of July. But I think if we see further gains back above 128, we could confidently say that perhaps the uptrend is back in play, and then a move back to 130, and indeed the highs from July could then be in prospect, with a bearish view really at least needing it to move it to neutral more than anything else would be back below 125.50. For the bears to take control, you'd have to see it sub the 200-day, really with any degree of confidence for the medium term, at least in terms of short-term reaction. I think otherwise it might be that we get maybe a contrarian move, which is a classic one, actually, talking about moves that catch people out. Dollar yen, because there was a big uptrend last year. It then weakened into year end, and it seemed to be as if we were having a downtrend take place. But then over the course of time, it's recovered, and here we are once again, dollar doing well against the yen. Crucially above those highs from late June, early July, when there was talk of Ministry of Finance in Japan intervention in the FX market. As in the way of markets, we've now moved back to that level and indeed moved above it. So the market almost thumbing its nose at the Ministry of Finance in Japan there. You've seen it move really sideways, consolidate since the middle of August after the big move from the July lows. So some consolidation, but that again could easily change if you get, even if you get a stronger payrolls report, so maybe that strengthens the dollar. So perhaps this is the one to watch for upside if you get a stronger payrolls report that then clears the way for further gains in the direction of these highs from October at 152. But just as you can argue for the others being an uptrend, this one is now, if you look at it from February. So at the moment, having created a new higher high in the uptrend, maybe a short-term pullback is the thing to watch for buying opportunity. And it would take a lot of downside here to really negate this view. The uptrend is in place unless and until we see it go probably back below 138, to be honest with you. And certainly you would have probably 140 and certainly back below 138. And finally, looking at commodity prices, if we start with gold, again, all dependent on the dollar today, what that does. But after yesterday's slightly mixed session, it looked as if we're getting a lower high here, but the buyers have come back in to defend it this morning. So the rebound is more or less intact. We're back above the 200-day. Maybe the bulls have come in to save this one at the last minute. We're back above 1900. The next big target perhaps that 1980 high, which stymied further gains in July. That's the next big thing to watch for. I think people feel a lot more comfortable taking a bullish view if we saw the price move back above that level, really, even if it means waiting for some more upside, which could then clear the way towards 2000 and higher. Alternately, back below the 200-day, as ever, would start to make me maybe change that view in the short term, take it to at least neutral, and then sellers will want that close back below lows of 2 weeks ago, around 80, 85, back below that, and you could then make a strong case for saying that the sellers are in charge once again. And then finally, crude oil doing very, very well in early trading this morning, but up another 1%. So over the course of the past week or so, we've seen oil prices gain 8.5%, back on the up once again. Classic short-term pullback. You're finally seeing the MACD cross higher as well, which is always a good reason of remembering indicators, of course, are lagging, but they do nonetheless show you what's happened. And here, it still looks like the uptrend is now forming after the long pullback from the summer highs of 2022, rounded price action here over the last few months at least. Staunch defense of 67, 68, back towards 84. The next target becomes those highs from the middle of November last year at 80s and 89, and then on towards those highs from October and November itself at 92, 95. But buyers certainly wresting back control here, coming in last week around 78.40 and continuing on from there and putting the upside case back in view once again. Certainly, of course, with that golden cross of the 50-day moving above the 200-day moving average there, that would tend to tilt the view at least towards neutral and moving really in a bullish direction now with further price action above the $80 a barrel mark. So for the rest of the day, well, we're waiting for that US payroll report at 1:30, which of course influenced the open for US markets. So from the Dow's open slightly higher from yesterday's modest reversal. That's the first thing to note. More positive open is expected, but of course we'll be covering payrolls live on IGTV at 1:30 with Beat the Street, so do tune in for that. That's it for me. Thank you for joining us. We'll be back as normal on Monday at 10:30.